So let me introduce myself. I'm Kwamie Dunbar. I'm professor of finance at Worcester Polytechnic. I've been at Worcester Polytechnic for 3 years. Prior, I taught at Fordham University in New York. I've taught at the University of Connecticut. I've been teaching finance for about 25 years. Plus, I've worked in the industry for a number of years myself. Now, tonight we want to talk about cryptocurrencies. It's one of the courses I teach at WPI. As I say to my students, when we're teaching cryptos and digital currencies, it's not to trade cryptos for us as an educational institution, but it's for students to understand cryptos, understand what we call digital currencies, right? Now, one of the things tonight I will say to you, and that is digital currencies, they're attractive to us for reasons not necessarily investing, but because they have attributes that could be used in the financial industry. For instance, there's what we refer to as blockchain technology. You're going to hear more about it tonight. My colleague David, who is here, who will introduce himself once he starts speaking, will talk about blockchain technology, how it works. It's one of those things that it's great if we're able to use it. For instance, to process invoices, to track products, right, and so forth. Cryptocurrencies are also what we call a use case of a lot of these emerging financial technologies that we have today. So as we look at cryptos, there are things about it. For instance, one of the attractive features is that it allows us to seamlessly have what we call peer-to-peer payments, right? We can make payments between each other quite quickly. So these kinds of attributes are attractive to central banks as they look to create what's called a central bank digital currency. For short, you may hear the term CBDC. A central bank digital currency, all it is a digital currency that allows us to make payments that we could literally transfer via our phones. Right? So for instance, government payments could be made via our phone, right? And you go to the store or wherever, you use your phone to make that transaction seamlessly. So crypto brought things like this to life. And that's why they're attractive, not only for investing, but also for these attributes that they allow us to see how they work. We started off in 2008 with Bitcoin. Bitcoin was a currency that popped on the scene. And its emergence, why did it come about? It came about because there were people, or I could say, we may all remember the great financial crisis of 2008. At that time, I was working at MasterCard as director of credit risk, and banks started failing. And at MasterCard, we had huge exposures. Because MasterCard doesn't issue credit cards, but what we do is that we give credit guidelines to the banks who issue the credit cards. So if these banks fail, we're on the hook because we need to settle those transactions behind the scenes seamlessly. So the vendor, the merchant, or the cardholder wouldn't even know that there was an issue with the banks. So in 2008, with the failure of the financial system, a lot of individuals started to lose faith in the traditional financial system because there was this whole issue of banks being too big to fail, right? So a number of individuals decided that maybe we need another currency. We need a financial system which was not manipulated or managed by centralized authorities. So they push for a currency that was what we call decentralized, standalone. And Bitcoin was the first to emerge, right, as one of these currencies, followed by Ethereum. And of course, we have others like Ripple, Litecoin, Stellar, and the meme coin, Dogecoin, right? Meme because it runs on just the news, right? Everything someone says, Doge picks up or the Dogecoin picks up on that. Now, these cryptos, they have no underlying fundamental value. Nothing that backs them. What I mean by that is the US dollar. Take the US dollar, for instance. Many years ago, the US dollar was backed by gold. And backing it by gold, it meant that if I decided that I didn't want to carry that note anymore, I could go into the bank and said, I need to exchange my dollar for whatever it's worth in gold. But because of the amount of currency that started to get into circulation, the government couldn't cover all these, right? So we call it the gold standard. It failed. It collapsed, and we went to a fiat currency. Now, the paper note in our wallets or purses, that dollar is backed by the faith and the trust that we have in the government that they'll settle it, right? So at least it's backed by that. Cryptos, they're not. And that's one of the challenges. How do you value them? How do you know what they're worth? That's where the risk comes in, right? A lot of these things, their values are determined by complex computer programs. And of course, they're traded, right? So for us, trying to come up with what is Bitcoin going to be worth today? Well, it's based on those complex computer algorithms that's running on the traders, right? What they're prepared to pay for it. And for most of us in this room, you saw where Bitcoin shot up to 100,000. It's back down, right? The only regret I have is that I remember when I could have bought it for like 9 cents and I never did. I was like, that's just a fad. It's not going to happen. And I had students who were mining Bitcoins. And I said to them, don't even waste your time. Today they're retired. They sold. I'm still working, right? So these cryptos, they fluctuate based on what the market determined their value to be. There are a few companies who allow payments in cryptos. There's one company, for example, MicroStrategies, that have spent millions of dollars buying Bitcoin that they keep on their books. I don't know why Michael Saylor does that, but he does, and he believes that Bitcoin is going to be something of some significant value in the future. So these products, they are mined, and we refer to as they are being created. New ones are being created. Now, Bitcoin is a little different, and it has a fixed amount, they say. So that's why its price keeps going up so rapidly, because each time they'll mine and they'll get new ones, they know that whatever is remaining is less and less. Unlike a Dogecoin or some of those others, which has an unlimited supply, it is claimed, the amount that is mined doesn't significantly affect the price that we see for that. So we say it has no collateral backing. It has nothing that, sorry about this, nothing that backs its value. And of course, you can buy them or sell them on some crypto exchanges, right? Now, I have bought these on exchanges myself to experience how they work, right? Now, it is said that they settle almost instantaneously, right? Well, if to be able to determine that, I need to buy it, right? But not buying Bitcoin, but buying one of those smaller ones, right? To see if that really is so as they're claiming. So the exchanges, they are the custodian of these products that we see being sold. Now, we say that they're decentralized in terms of their issuance. We say that they're decentralized because they're not connected to this centralized financial system. That's the claim. And they're operating independently of government monetary policy, right? Because when interest rates rise or fall, it affects the value of the dollar, or when inflation moves. So it is claimed that it's decentralized, right? It helps or leads to some amount of disintermediation of the banks, because what it does is that it's taking some of the transactions that are typically taking place within the banking system out of the traditional banking system as individuals trade in these products or carry these kinds of currencies. Now, for us, we say that we trust in the faith of the U.S. government to settle or back the currency. Here, our trust and faith is in the security of the technology that is running these types of products. Now, so cryptos, we have our Bitcoins, our Ethereums, our Dogecoins. These are different types of coins that you could use. And of course, as I said, there are some vendors who today, or some merchants who will allow you to pay in using those cryptos. All right. Now, a lot of these coins, there are hundreds of them. They're not easily interchangeable, right? You can't necessarily spend them as easily as your regular US dollar, right? Currency, or your Canadian dollar, or your euro, or so forth. So what has come about is what we call stable coins. That's another class of coins in the digital sphere that has been created. And the reason for these digital coins, I like to say, to make it simple, if I am buying and trading in cryptos and I have different pockets or pots of cryptocurrencies, if I want to move between the crypto space and the regular centralized space where we live, right, then I need to use stable coins. These allow me to shift out of the crypto space. So I have Bitcoins. I have Ethereum, Dogecoins. Well, what I can do is exchange them when I need to transact into these stable coins. If I need to invest, I can exchange them for these stable coins, because these stable coins, they're called stable because they're pegged to the US dollar, 1-for-1. Right? And the issuer works to ensure that they stay stable, 1-for-1, right? It's a pity that these came about a little late. I remember an early transaction where someone sold a piece of real estate in Florida, and she took her proceeds in cryptos, Bitcoin. Now, Bitcoins are highly volatile, or cryptos are highly volatile. And overnight, she lost almost $50,000 in her proceeds, right? That just went away. Now, had she used stable coins, it would be a 1-for-1, so she would have been protected, right? But stable coins have been fairly new. So here in the United States, one of the most popular is this one, the second one, which is USDC. Right, it's fairly popular here. USDT is more popular overseas, right? In Europe and other areas, you find it operating a lot. USDC, I love it because they're transparent in that they share information as to what their entire operation is. USDT, the issuers of that, they're not as transparent. Right, so you're not sure what is happening with them or what could happen with them. But USDT let us know how much, and the thing about USDT and most of these stable coins, they claim to be decentralized. And that's why I use the term claim. But they're not exactly as decentralized as you may think, because this is one of the weaknesses in what we call the decentralized finance sector. For short, we say DeFi sector. One of the problems is that they tend to hold on to, for instance, US treasuries. That's what they use to back these products, right? To help to make them stable. And there are times, if there's volatility in the financial system, they may need to go in and buy more US treasury to keep that 1-for-1, right? Now, that creates a channel through which they're influenced by policy changes, right? So they're not as decentralized as they would like to think that they are, right? So that's one of the weaknesses that we see in that. All right, I'm going to let David introduce himself and say more about in terms of the blockchain infrastructure that we have and some of the things that have been happening within the crypto space.
My name is David Juma. So I'm a founder of a FinTech startup called Our Bank, right? The operative word being our, right? So our goal is to bring more inclusive and faster payments to everyone, right? And for us, it's like a personal passion of mine. So within the United States, we're going through the biggest transformation that has happened probably in the last 40 years. So what a lot of folks are not really cognizant of is, at the end of the day, all the way money moves in the United States is literally built off technology from like 40 years ago. It was built in the 70s, right? But now with newer technologies, we have a generational opportunity to finally move into the future, right? So the future of payments is going to be cheaper, it's going to be faster, and hopefully better. And so that's the premise of what we're building at our bank, to lean into these foundational changes to build more capabilities that work more for people. So I spent pretty much my professional career has been in financial services. I started more on the advisory side of the house, right, giving advice and doing audits for financial services organizations. Then I spent the next 5 years at the Federal Reserve Bank of Boston, where I was brought in to provide risk oversight and transformational oversight over what we call core financial infrastructure. So those are the systems, the people, and the capabilities through which the central bank, the Fed, is able to execute its missions and mandates. And then I had a similar role, providing risk and audit oversight over what we call critical national payments infrastructure. So those are the various systems, capabilities, and processes that are utilized by the US Treasury to essentially get paid and pay other people. And, fortunately, unfortunately, it's been in the news lately, right? There's this part of the Treasury called the BFS, the Bureau of Fiscal Services. So my role was to provide oversight over the various systems, capabilities that the Federal Reserve System essentially provides on behalf of the US Treasury. So whether it's your Social Security check, whether it's the incoming payments, Medicare, whatever, bond payments, whatever transactions. Because one of the things that was very, very apparent during the great financial crisis was the various systems and capabilities that between the Treasury had and the Federal Reserve had did not necessarily work well, because we're built, like I said, in the 70s. So we got to move it up. So what I'm going to do today is to briefly, why are we here today? And why is this change? Right? So there are two foundational payment infrastructure changes that are ongoing. The first one is centered around the emergence of what we call real-time payments. Okay? So if you think about how you get paid, for if anyone's working, you realize that most people actually get paid on Wednesdays, but they don't see money in their account until Friday, because the way the money is moving is actually slow. It takes about 2 to 3 days. That's why you can pay something, or you can push out a payment for your mortgages, and then I paid, but the bank was like, no, I didn't get the money because it's moving slow through the ACH rail. So the first foundational change that's occurring is a transition to real-time payments. And the biggest one that's out there, it's FedNow, and you hear more about it going forward, which is managed, operated, and governed by the Federal Reserve Bank of Boston. The other seismic change in payments is the emergence of digital currencies and digital assets, right? So instead of you having a fiscal dollar in your pocket, right, a note, is now represented digitally. So why do we have these? Fundamental to all these types of digital currencies is the emerging technology of blockchain and DLT, which is distributed ledger technology. These are the foundational technologies that underpin all these variations of digital assets and digital currencies. So, broadly speaking, there are 4 types of digital currencies. One is the OG, the original one, which is cryptocurrencies. And the biggest one is Bitcoin. So those, like Professor Kwame said, were created as a response to the great financial crisis. And they were initially created to kind of make original intent of Bitcoin was to serve as a medium of payments and or transfer of value. But, it's since morphed into something else, right? You can call it speculative assets, you can call it investment, depending on where you sit. But it's not serving its original intent. So like anything in the world, if something's not working, we got to do better. And so the better, as a response, was the emergence of stable coins. Because if you think about Bitcoin and Ethereum, they're all over the map. So if I want to pay you, or you want to pay me, and the value is always fluctuating, then I can use some sort of medium that inherently has a fluctuating value. Whether I'm a small business, whether I'm getting paid, you can do that. I mean, I can go to the store and say, oh, I have 2 Bitcoins, and I'm going to buy orange juice, and it's supposed to be like 3 Bitcoins. Then I get there, it's like 7 Bitcoins. It doesn't work. And if you think about the concept of money, money has to have value, right? Money has certain characteristics. And one of the enduring characteristics of money, for something to be called money or to serve as a form of payment, the value has to be reasonably stable. So anytime something is supposed to be used as money or as a payment and it's not inherently stable, then it undermines the ability to function as money, right? So guess what? It's not stable. Well, let's make it stable, and let's call it stable coins, right? So that's how stable coins came about, as a response to, mostly driven by the fluctuation in values with the original cryptocurrencies such as Ethereum and Bitcoin. So, like anything else, some people elsewhere were like, well, wait, you mean the private sector is going to coin money? So if you look at the Constitution, right? If you think about it, I'm a kind of history person, so sometimes I kind of pivot a little bit in history. So if you think about money and you look at the Constitution, the ability to coin money is designated to the government, right? And as a private individual, I cannot coin money. Back in the day when we had free banking, yes, you could. Any person or any institution could come up with banking. And there was a whole lot of drama out there and a whole lot of collapses. And so the response was what? The establishment of the Federal Reserve to essentially execute the ability to create money and coin money. So if the ability to create money is moving out of the government and is going into the private sector, there's a problem, at least from a government perspective. Because all central banks, one of their core mandates is monetary policy, and also in most countries, they are effective monetary policy, but they are also doing what? They're also the foundational payments infrastructure. So if that responsibility is transitioning out of the central banking apparatus, then they become inherently ineffective. You need 1 + 1 to be able to get to 2. So if 1 is not there, you can't get to 2. So as a response, the regulated banking infrastructure and organization, we're not big fans of stable coins because it's taking power and responsibility away from us. So we, as the banking sector, we need to react to that because there are people that demanded more digital currencies, right? So the response is twofold. One set of response, which is actually the majority, a lot of countries are looking at CBDCs as a response, central bank digital currencies. So there are over 135 countries in the world that are exploring the use of central bank digital currencies. But central bank digital currencies has positives, but there are also issues, all perceived issues. The biggest one is about privacy. which a lot of people have concern of, right? So and the way banking works in most countries, you have what's called a two-tier banking system. One is you always have a central bank, and then you have the regular banks. And together, they form the banking infrastructure. One of the core responsibilities of commercial banks, right, is to actually, through fractional reserves and fractional banking, increase the money supply. But when you have a central bank digital currency, it could undermine the role of commercial banks. So in some jurisdictions, some of the banking institutions are not too happy with the emergence of CBDCs. So guess what? There's always a response to something that's ineffective. So then the compromise is essentially the concept of tokenized deposits. So with tokenized deposits, essentially is taking the essence of how we do banking right now with cash in our wallet, but just representing it in a digital form. So when you think about the universe of digital currencies, there are 4 buckets. There's cryptocurrencies, there's stable coins, there's CBDCs, and there's tokenized deposits. And each of them have their positives and their negatives. And over the next few years and decades and in coming centuries, each country in the world will move to some sort of digital currency, because everything that we do is digital. So why would still hold paper? But there are some folks and some jurisdictions that will pivot more to CBDCs for their own reasons, and there are some that are going to not go with the CBDC, but go with more like a tokenized deposit, which is more of a maintenance of the current structure, but just representing it in a digital form. So I kind of wanted to recap, number one, the foundational technologies upon which all these things are built, right? And then also recap some of the 4 major categories of digital currencies. So here we have there's a few things that I just wanted to call out in terms of key concepts. This is a little bit on the nerdy side, but the foundational technologies are DLT, distributed ledger technologies, and blockchain. The only thing I wanted to call out that all blockchains are DLTs, but not all DLTs are blockchains. That's it. Because very often people kind of think it's the same terminology. Within technology, anytime you have something, it needs to sit upon something, a database. So a DLT is just a database that's distributed. Most databases are centralized, right? So if you have a Google Drive, yeah, it's kind of centralized because it's only you control that information, maybe other than Google. With DLTs, it's the same concept, but the ownership and the governance of the underlying data that sits on the database is distributed. And so that's why it's literally called distributed. The ledger is not one, it's distributed.
So if us here in this room are trading a new cryptocurrency, right? We could create a ledger, just like a checkbook. You know, we refer to our checkbook as with our ledger.
Yeah,
right?
that's great.
So we could then keep a record of all those transactions between us in this room, but it's shared between us. So we all know what our balances are. We can see what each other has, right? And that's what makes it distributed. And as David indicated, that will help to take away some of that privacy that we believe we have, because now it's public, right? But I want to tell you, in the real world, even at the level of banking, there's really no true privacy. Because when I was in the banking system, I knew what all your transactions were, right? I knew what your paycheck was. I knew what your mortgage payment was, your car payment was. When you take vacation, I knew everything about you, right? So that's why as banks, we could market to you, target market to you, because it wasn't private as you may think it was. But that's what David means by that distributed ledger. That's how the blockchain works, and that's what helps to make it secure. Because we all know, and we can all see what is in there, right? And if someone tries to do something, we all see what that person.
So these are, I'm just going to quickly go through. I kind of wanted to establish the 4 different types, and then quickly go to some of the and also talk about the foundational technology upon which all these 4 variations are built. and let's call out some slight differences, advantages, and perceived disadvantages across the various types, right? So we talk about DLT, distributed ledger technologies, right? Consensus, we all need to agree. So if I make an entry of the number 1 in the ledger, there needs to be a consensus that the number is 1, right? That's very foundational in a lot of these things. There's how do you ensure that 1 is 1? There's a lot of, you can either have a proof of work situation or a proof of stake, right? It could be public, that means everyone knows, like literally everyone can know at least or it could be private. So these are varying concepts, right? And it could be on-chain, which is just it's on the thing, and off-chain. It's so interesting, right? Within DeFi, a lot of these concepts are not new. They are just rebranded, right? So when I think of off-chain, on-chain, I either have it in my wallet or it's at the bank. It is the same concept, right? All these terminologies are just essentially a fancy way. So we briefly talked about what NFTs are. Those are just another representation, just taking some sort of asset and representing it on some sort of blockchain or DLT technologies. I think about 2-3 years ago there was a lot of noise about NFTs. I think they were the hottest thing since sliced bread, and I don't know what happened, but they fizzled out. So these are some examples of some of the popular ones. Everyone knows about Ethereum. I think, was it 2 days ago or 3 days ago, there's a lot of talk about the establishment of a crypto reserve, and there were 5 currencies that were, I guess, how we say, nominated or shortlisted for potential establishment. Of course, it's the usual suspects. You see a few of them here. You have Ethereum. You have Ripple. Ripple is the company that does XRP, right? So that's in there. Bitcoin was there. I think Solana, I've forgotten the 5th one. It was Ethereum, XRP, Solana, Bitcoin, and there was something else, but I've forgotten. But there are like 5 of them that have been, floated around as potential, the potential universe of when the time does come, the establishment of a crypto reserve by the administration. So one of the things that is kind of interesting to know is when you think about crypto, you always got to look at 2 things. Usually you have an organization and a platform, and then they might have their own currencies. So I talked about Ripple. So Ripple is a company, right? And their cryptocurrency or stablecoin, they have XRP. So that's why I kind of wanted to call out between the companies or foundations very often and the assets and the cryptocurrencies that they're minting or creating, right? And here we have some other same things. You get engaged with them usually through some sort of exchange. We spoke about them. There's this concept of, are you going to self-custody, which is, are you going to hold the keys to your crypto wallet? Which is very interesting because if you lose it, there's a problem. There's been some interesting stories out there. I think there's an interesting story out there about some guy in the United Kingdom that is still going through some landfill because he lost his keys. It's like he's been doing this for, it's like almost like 10 years. He's back and forth with the municipality. He wants to buy the landfill, and it's very interesting. But that's okay. So at the end of the day, all these assets cannot operate in isolation. They still require the engagement of the current financial infrastructure. So a lot of the large custody banks like the BNY, Bank of New York, the BlackRocks are still, at the end of the day, the ones that are actually either holding the assets and or holding some sort of collateral against that crypto. So it's very counterintuitive because the whole premise of DeFi was like, we're going to do our own thing without the banks. But they cannot do that in reality without the banks. So go figure. A few more here. So we talked about Ripple, XRP, Ethereum, Foundation cranking out Ethereum, Bitcoin. No one knows who did it. And then we have a meme coin. Here we list some of the advantages and challenges. There's also a perception of whether you see that as an advantage or a disadvantage. Some people might actually say that the limited, know your customer is an advantage. Some people might also say it's not, right? So if you think about Tether is very interesting. It's the most profitable company in the world. They have just a little bit north of 100 people. And they make more money than BlackRock. So that's very interesting. If you look about the revenue, if you look at how much profit or revenues they make per employee, it's like 100 million per employee. But one of the reasons why they're so successful, depending on how you look at it, is that they are utilized to facilitate cross-border payments. Whether the payments are good or bad, that's for a different day. But they're serving a need. And that's why they're so successful outside the United States. So we talked about stable coins, the biggest one in the United States. So we talked about the two big ones, right? There's Tether, which is like in a different league, right? And then, which is mostly utilized outside of the United States as a means to move money across borders. But within the United States or affiliated with the United States is Circle. That's the company. And their stable coin is called USDC. And they have a Euro version, which is called EURC. Very creative. One of the things I kind of wanted to touch upon is with the stable coins, there has to be what's called a stabilizing mechanism, right? So there are various ways you can stabilize it. One way you can stabilize it with buying US Treasuries, so 1-for-1, right? Another way you could stabilize it is with another cryptocurrency. Okay, that's okay. That's, I'm not passing judgment here. I'm just, right? Another way is, you know what? We are so smart and we know so much code and computer science. You know what? We're not even going to back it with a physical asset or a virtual asset. We're just going to back it with code. And if you work in tech, there's this concept that in code we trust, right? Right. So just and let's just say that that philosophy has not been as successful, right? A lot of the recent failures were what they call, you hear them algo cryptos, right? I think FTX was one of them, right? The biggest one, really smart guy, so everything was doing, in code was great. So those are some of the characteristics around stable coins, and we talked about how they could be backed. Either they're backed by real world assets, it could be backed by gold, it could be backed by a chair. You could literally do that if you want to. I don't know who's going to buy it. It could be backed by the US Treasury, which is a good, or it could literally be backed by bank account balances, right? Which is what tokenized deposits get to. We can talk about a few of them. Look at the market cap. Every time you look at Tether, I think right now it's probably 30 billion more. It's just going gangbusters. Talked about some of the real reasons why stable coins were created. Initially, they were created to serve as on-ramp, off-ramps for other cryptos. And now there's an emergent opportunity that they can be utilized more for cross-border payments, right? So if you look at globally, there are certain countries and jurisdictions where the currency is all over the place, right? Just like maybe Bitcoin. So in response to that, some of the citizens, what they'll do is we think that dollar is probably the best bet, but we don't have access to dollars. So what can we do what's the best alternative to a dollar? Well, let's get a USDC or let's get a USDT, right? So a lot of these stable coins are serving as, beyond functioning as payments for across borders, actually serving as a store of value, especially in high inflationary countries. And then CBDCs, which is popular everywhere, but not popular in the United States, which, I always say that it makes sense, right? Because the way the financial structure is set up in the United States is very different. A lot of people don't recognize that. That is very, very different than other countries. So if you take $1 out of your wallet, and you look at it, it's the physical dollar, you realize that it's not printed by the United States government. Yeah, you didn't know that, huh? Now you do. A lot of people don't realize that because the way in most other countries, almost every country, there's only one central bank. In the United States, it's actually bifurcated. There are the folks that sit in DC and the folks that sit out of DC. So the power of the ability to execute monetary policy and coin money per the Constitution was given through to the Treasury and through the Federal Reserve Act to the Federal Reserve Board of Governors, which sits in DC. If you go to their website, the extension of their website is .gov. And then you have the 12 reserve banks. The 12 reserve banks, and Federal Reserve Bank of Boston is one. There's one in New York. There's one in Atlanta, Philly, all over the place. There are 12 of them. And they're all focused on serving a geographic region. Now, if you look at their extensions of their website addresses, it's not .gov, it's .org. I didn't know that until I got there. I didn't know that, so you good. And I tell people, so it's very, very different. I think that's a very, very interesting thing. And the reason why I bring that up is, if you think about CBDCs and why the concept of a CBDC is very, very counter to the way the central banking system is set up in the United States. Because the central banking system in the United States is not 100% operationalized by the government. It's split between the government and the quasi-private sector, which is very different than any other country. So when I think, this is a personal opinion, if we're going to have digital currencies in the United States, then it will mirror our existing banking structure, which is split, central banking structure, which is split between the government and the quasi part of the government. And so that's why CBDCs might have a role, maybe at what they call a wholesale level, but a retail, I personally believe that it will be something else because it has to mirror the way we do banking here, especially central banking. So I'll tell you something. So when I was at the Fed, there was this one guy, really smart guy, and if you think about cash, if you think about any company or any individual's financial statement, cash is usually what? An asset on your financial statements. If you go look at the Federal Reserve Bank of any and look at cash, it's actually a liability. And it was very interesting because a lot of people couldn't understand why I think of cash as an asset. No, it's a liability because of the way the central banking system works here and the fact that there's nothing else, that's the beginning of money supply. So it inherently has to be a liability so that it can be an asset of a bank. And he did a great job explaining that because people just couldn't get it. So I know I digress a little bit, but the reason why I want to bring it out is that we got to think about digital currencies, and especially in the United States. When that time comes over time, I think it was going to be more reflective of how central banking functions in the United States. It's going to be fundamentally different from probably every other country because all other countries don't have that structure. That's all I want to say. So what's going on with CBDCs? Like I said, there are 135 plus countries that are experimenting, right? Either they're thinking about it, they're doing research, they're developing, but guess what? There's only like 3 or 4 countries that have actually gone live, right, in a meaningful way. The INAIRA in Nigeria, there's a pilot in China, there's an ECD pilot in Ghana, and the folks at MIT and the Boston Fed did a proof of concept, right? But with a lot of the conversations that's going on right now, from the legislature point of view, then just from general sentiment in the United States, a lot of folks are not that excited about CBDCs, coming mainstream in the United States. But there's an appetite for stable coins. And so there's been a lot of, through executive action, and even a lot of recent bills that over the last month have been just started popping up left and right And essentially, they have one North Star. And the North Star is essentially, if the United States wants the dollar to be the dollar, right, and still have the power that comes with the dollar, then the United States and the dollar needs to be digitized. That's a given fact. And so there's a lot of conversations and a lot of legislative action that's ongoing now to move the regulatory regime forward to make sure that we have an equivalent of a digital dollar, which most likely will not be a CBDC because the appetite is not there.
Yeah.
All right. Thank you for having us. Okay?